Welcome everyone to Vested Interest. This is Shane, and before we get into the video, I'd like to take a moment to thank everyone who's taken the time to watch, comment, and like the videos, and a special thank you to those who subscribe to the channel. I really do appreciate it. If you have not hit that subscribe button, go ahead and join us on this journey to financial freedom. Join the Vested Interest community, trying to build a like-minded community of dividend growth investors so we can share our experiences, stocks we're watching, stocks we're invested in, dividends we're paid out, everything around the dividend investing community. So go ahead and hit that subscribe button and hit that notification bell so you're notified whenever we put out any new videos. This video is our portfolio update, all the activity in the portfolio for the week. And we did add $1,310 to the portfolio. So let's jump right in and see what else happened with the portfolio. So we did some covered calls this week, actually. So we did one on Williams-Sonoma, right? $114 strike price. So we own 100 shares of Williams-Sonoma, and we were willing to sell them at 114. And this was called away. It was a little over 114 and some change there at the close of the week. So these 100 shares are off, but we did keep the $239.45 in option premium. So that cash went right back into the portfolio, and then what we are going to do is turn right around, and we'll take the proceeds from this sell, right, that we sold this call on, and we will do a cash secured put, and we will keep running that wheel and collecting the options premium whenever those hit. So again, this was a covered call, 100 shares of Williams-Sonoma, set to expire on May 19th at $114 strike price. This was called away, so now we have the cash from those funds, and then we're going to do the same thing in the opposite direction and do a cash secured put. So $239.45 on May 15th in cash, and we did add this back into the portfolio. We will see that here in a moment. Next up, on May 15th, we had quite a few companies pay out dividends, and they started to roll in with Omega Healthcare Investors. This is a REIT out of the real estate sector, ticker OHI. They paid us $167.55 in dividends, and we have the drip set on, so these are reinvested right back into the companies within the portfolio. So this $167.55 went right back in and bought more shares of Omega Healthcare Investors, and we picked up 5.68016 shares with the dividends paid. And Realty Income paid us also on the 15th. They paid $30.69 in dividends. And again, drip set on, so we went right back in and we picked up 0.49606 more shares of Realty Income. Procter & Gamble also paid out, Realty Income is ticker O, also a REIT out of the real estate sector. And then Procter & Gamble also paid out dividends, $20.97 paid out by Procter & Gamble, ticker PG. This is out of the consumer staple sectors. They paid out the $20.97, and then that went back in and picked up 0.1348 shares of Procter & Gamble. So this snowball really is starting to pick up now. This hopefully is showing you what the dividend snowball is all about. And then lastly, on May 15th as well, Ally Financial, ticker ALLY, out of the financial sector, paid out $51.21. Right back in and picked up more shares of Ally, 2.02903 shares added. So all total, we were paid $270.42 in dividends. Those dividends went right back in and bought more shares, and that added an additional $19.67 in annual passive income. So over the next 1 year, these new shares, or fractions of a shares in these cases, will pay out $19.67. So $270 will turn into an extra $19, and that is the snowball in action. And then another part of the snowball are my new investments. So the options paid out, plus additional income that I added in the portfolio. Part of that $1,300 you saw on the first page, we spent $912.58 in new capital on May 16th. And with those funds, we bought 10 shares of Bank of America, ticker BAC, out of the financial sector. We picked up those 10 shares at $27.39 per share. We picked up 7 more shares of Vale, ticker VALE. This is a mining company out of the material sector. And we picked those shares up at $13.80. We picked up the Bank of America shares at $27.39, if I didn't mention that. Like I said, 7 more shares of Vale there, material company out of the mining sector. Then we picked up 2 shares of Williams and Sonoma. Since we sold a covered call, we used part of those funds to buy 2 shares of the same company that we sold the call on. So we picked up 2 shares of Williams Sonoma, ticker WSM. This is out of the consumer discretionary sector. We picked up those shares at $111.04. And then we picked up 2 shares of Johnson & Johnson. This actually dipped down a little bit lower in 158 range, I think is where I saw it ended the week at. So I wish I would have waited on this one a little bit, but you can't really time the market. So hopefully it stays down there next week, and I'll look to add a little bit more Johnson & Johnson. I like it under 160. I like it at 160, so obviously I like it at under 160. So we picked up those 2 shares of J&J out of the healthcare sector at $160.01. All total, this $912.58 added in new capital, added an additional $30.42 in passive income. So you're really seeing the amount we invested, the dividends paid out, is really starting to add up in that passive income over the next year, which also increases that snowball. So it's all just compounding on itself at this point. Really nice to see. And we weren't quite done. We went back into on Friday, the 19th. This is my brother's birthday. Happy birthday, Joe. And we picked up we added $397.81 more in new capital, right? And part of this is the capital that we got for that covered call from Williams and Sonoma early on we saw. 2 more shares of Union Pacific, ticker UNP. This is out of the industrial sector. We picked up those shares at $198.90 per share. I like them anything under 200 really. I think they were a little, so this is kind of the reverse of J&J. They were down in the $196 range earlier in the week, so I wish I would have picked them up earlier and picked up Johnson & Johnson later. But again, still like these guys under 200, and you can't time the market. That just kind of shows you, just get the shares that you want to whenever you see the value in them, right? And this $397.81 in new capital with the 2 shares of Union Pacific, that added an additional $10.40. So all total, we invested $1,310.49 there in new income, including that covered call, the funds we got from that covered call, right? And all total, that added an additional $60.49 in annual passive income. So the snowball effect is in full effect here, continuing to increase my annual income. Back on track here now. From those sales we had a couple weeks, we are back in the green, back headed in the right direction. So very nice to see the added passive income in the portfolio, $60.49. This is about what we're averaging right now, $60 or so per week. Now, a quick run through the sector weights, the sector allocations here. Communications is sitting at 8.68% of the portfolio. Consumer discretionary makes up 8.71% of the portfolio. Consumer staples is sitting at 5.94%. I would love a pullback in this sector, either with Procter & Gamble or Kraft Heinz within the portfolio. I'd really like either one of them to pull back so I can add here. Energy is sitting at 7.62% of the pie. Financials sitting at 11.92% of the overall portfolio. Healthcare making up 13.20%, and this with the Pfizer addition and the Johnson & Johnson, this healthcare sector is starting to creep up there a little bit, but I don't mind that. I like the healthcare sector. We have an aging population. I don't think that the healthcare sector is going to decrease in size. I think it's going to increase in size as we see some of the older generation hit their golden years, let's say, and need more medication, more care, more doctor visits, that sort of thing. So I think this sector here is a good one to be in, regardless of how the economy is doing. Right? When people need to go to the doctor, they're going to go to the doctor. Industrial sector is sitting at 8.39% of the portfolio. Technology 9.72%. Materials makes up 11.49% of the portfolio. Utilities, still nothing in the utility sector. REITs and real estate is still the largest sector at 14.32%. We didn't add anything there. And as we add to some of these other sectors, hopefully this pulls it back down. I think I've mentioned it before. I do not like any one sector to be over 15% of the overall pie. Try to keep this spread out evenly, so whenever we're having a downturn in one area of the market, maybe another area of the market can carry the portfolio. That is the idea behind diversification. We do not have any ETFs. I consider my portfolio its own ETF. I have created an ETF with the stocks inside the portfolio, right? Mine is just around 22 shares. We'll see that in a minute, exactly how many positions I own. Now, this is another way to look at the same information over here, but I do give a little bit more, but you can see communications, the percentage of the sector that they are, and then also how much in capital I have in each sector as well. So in communications, for example, $11,674.30 total. You can pause this, go through that if you'd like. And I also like to be as transparent as possible, showing you exactly what I'm holding in my portfolio every week, whether I'm up, whether I'm down. I'm going to share that with you, what I'm buying, what positions I hold, how many shares I hold, my average cost. Everything is laid out here in front of you. And here's the ticker, right? Tells you all the positions within the portfolio. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21. So currently 21 positions within the portfolio. How many shares I hold, the current price as of the close of business on Friday, the current market value, which is total shares times current price. My average share price, what I paid for the average amount of shares I have, and the purchase price, how much I have into it. Total return, whether I'm up or down, you'll see it here in this column. So the red here, these are the ones I'm down in. The other ones I'm up in. Percent return, sector, which sector they fall in, whether they're a quarterly, monthly, or semi-annual dividend payer. The current yield, again, as of the close of business on Friday. My yield on cost. Portfolio weighting, how much of the portfolio, so we saw the sectors weights before, now you can see individual holdings. So Ally makes up 4.18% of the portfolio. The estimated annual income is found here, what months they pay out here, the dividend growth currently year over year, and this is what I like to look at. One of the criteria I look at, if I'm looking to add a new stock, I'm not going to pick it up unless it's within 15% of its 52-week low, or if it's a position already in my portfolio, it's under my, I like to add them when they're under my cost basis. So Ally, for example, is at $26.43. That's over my cost basis of $25.54. So I'll wait for a little pullback if I want to add anything here, right? Now, if it doesn't pull back under my cost basis, then I just go look at some of my other positions and add there, right? So let's go through the totals. Currently, total amount of shares of the overall portfolio, 3,800 shares, 0.81 fractional shares there. The market value is $134,487.04. I have $139,092.32 in it. I am down $4,605.28, down 3.31% in the red. Current yield of the portfolio sitting at 5.009%, just over 5%, very nice dividend yield. And my yield on cost is very nice at 4.843%. Now, this is, in my opinion, what it is all about. The estimated annual income, the passive income provided by the positions within the portfolio. If I wanted to turn off the drip and use this funds to pay my bills, I could do so. Currently sits at $6,736.82 in annual passive income, right? So that is well over, about $500, a little over $500 a month here. What I would average if I turned off the drip. And the last one, dividend growth year over year, 7.92%. The overall portfolio is growing at 7.92% just with dividend growth. Whenever the companies in the portfolio increase their dividends, this is what it's averaging, right? So that's about 7.92% growth just from the dividend increases. Well, that is it. Hopefully your portfolios are doing well. Right now, there seems to be a lot of green in some of the tech sectors. So if you're tech heavy, you're probably doing very well. Other sectors are still pulling back a bit. I'm trying to add to those sectors where they're pulling back when they pull back. That is the whole idea. I don't mind the red. I know that's strange to say. A lot of people want to see the green in their portfolio, but I prefer in what I'm in now, accumulation phase, it to be as cheap as possible. I want more shares at cheaper prices with higher yields so that I can have better future returns. That is the idea, in my opinion, overall future returns in the name of dividends, as well as some stock appreciation would be nice as well. Well, as always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Hit that subscribe button down below. Join the vested interest community. Hit that notification bell as well, and drop a comment in the comment section. Let me know what you think of the video. How is your portfolio doing? What stocks do you own? How many shares or how many positions do you own in your portfolio? What do you think is a good ideal mix? 20 positions, 50 positions, 10? Some people like to be really concentrated. Let me know what you think down below. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. Go ahead and drop them all down there. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by, and we'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk and comes money and should never invest in amount and uncomfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice counsel of a certified financial advisor.